It is a good morning. So, you know the drill. I'm checking Twitter right now. If you guys could give me a 5x5. Everything's clear on the chart and the audio is good, volume good. I'm doing a latency test as well, trying to give me a feel for how much time it takes to get to you. Thank you, folks. Appreciate that. All right, so let's get this circuit started. So we have the dollar index chart up here. Hang on 1 second, I got my headphones on. Don't want them on while I'm talking. So I did 2 live streams on Wednesday, 2 days ago, and I did the morning session review and what I felt was likely to be impactful. And then you saw it come to pass, and then I did a review on Wednesday afternoon, giving you a review of what took place and then what I felt would be likely for Thursday's trading. Everything to script. So without stealing the thunder from those 2 live streams on Wednesday, I'll counsel you to go check those out. I added them to the 2023 ICT Mentorship playlist on my YouTube channel. Today, we're just going to go briefly through, but reminding you that there is 2 economic drivers that are coming out at 8:30, so in about 19 and a half minutes, we will see the PCE price index, core PCE price index rather, and then at 10 a.m. the revised consumer sentiment number. Okay, so we'll probably see some volatility around the 10 o'clock hour. So you'll probably get a pretty good silver bullet setup during the 10 o'clock to 11 o'clock hour. I will not be trading again today, or we're planning to do some things this weekend, so it requires us to do some shopping and making things ready around the house. So with all that said, let's get into this. The dollar index is our daily chart, and as I mentioned on Wednesday, we would likely see it trade back into the range that it's created. And here is Wednesday's trading, retracing, and here's today's trading. Now, if you take note, we have this delivery and price all through here. And if you look at this a little bit closer, I promise not to keep you too long. On Wednesday, I was a little more lengthier than I wanted it to be. Okay, so this area in here, watch this intraday today, especially around the 8:30 and 10 o'clock hour when the news event comes, because this inefficiency is the only one on the daily chart. So we have all of this run here, no inefficiencies until we get down to here. We're right at this one now. Okay, so we did in fact see the retracement. We got down below an old high, which was a target months ago. So we got through that. I'm not convinced that we have ignored this or have abandoned the idea of trading back into that range. Again, count you to go look at the live streams on Wednesday telling you what this is and why it's important to me. Not that it should be important to you, but just observe and watch what you get. We have a volume imbalance here inside of a fair value gap. See that? So you want to study that also, and you'll see that that's where we basically trade to, and it coupled with the last up close candle. So this is a bearish order block with a fair value gap and a volume imbalance. That's 3 PD arrays. Then you see the reaction here on dollar. We opened, traded up, made the high of the session, back down into a discount range. Pardon me. seasonal allergies, folks. And that's another reason why we're going to try to get through this quickly, because I know my voice is going to be lost eventually if I have to keep talking. Haters are like, lose your voice. So we have this wick as well as a discount range objective on the downside. So we'll be looking at this range here to here. You can see the consequent encroachment is tagged there. Okay, so anything below this consequent encroachment on a closing basis on the daily chart means that we probably have to come back a little bit deeper than I'd like to see it, which means that we could see it go into this area here. I'm not suggesting that's the case today. I don't think you should be trading today. I think you should be content with what you've basically taken out of the marketplaces this week. We've had a really good analysis. We've had a really good price run over the last few weeks, and it's Friday. If you have profits on the week, the worst thing you could possibly do is offer them up on the altar to have them taken away so you can go into the weekend sulking and regretting the fact you did it. Moving on over into the euro. I'm getting a lot of feedback in the comment section because I'm back to talking about Forex. I'm going to talk about Forex when it's salient. When it's not, I won't. Okay, so don't get your hopes up on it being a steady diet of it. But when it's important enough for me to mention, I will. All right, so we mentioned on Wednesday we would likely see, well, prior to Wednesday, we were looking for it to trade below these lows in here. We did get that on Wednesday, and I said it's prime time for it to either consolidate and or retrace. We've done a lot on the downside. We traded into sell side liquidity. Thursday can tend to make what? The opposite end of the weekly range, especially if we've met long-term higher time frame or intermediate term targets, meaning it's dropped a lot from here all the way down through this low, that low, and this low here. So the sell side liquidity below there is now, I wouldn't say purged, it's been engaged. I'm not convinced that we're not going to go a little bit lower. I still think that this low here will be eventually treated to. Longer story is I'm still bullish on dollar. I don't believe we've reversed. I don't think that's the top. I'm welcoming being proven wrong. That's fine, because on the lower time frames, I'm pretty accurate in that. But on the higher time frames, on the long-term reversals, I allow for the market to give me a lot of information before I change my convictions about it. So I'm willing to submit to being wrong more on the daily charts at higher time frame reversals, which is why I try to avoid picking bottoms in bear markets or tops in bull markets. And it sounds cliche. You hear everybody say, don't try to do this, don't try to do that. But yet everybody writes books and courses about how you should do it, right? Or some kind of pattern. But on Wednesday, we talked about the likelihood of a retracement. And you can see we did, in fact, have that on Thursday, and then the follow through today. If you look real close, there's a small little inefficiency right in there. So I want to zoom in and take your attention to the levels that I think are salient for today. This wick is lower than that one, or tail, because it's below the candlestick's body. So you want to have this noted here on your euro dollar. So 1.0638, and what is that, 3 pipettes? So you want to have that noted there. I'm not going to leave it on my chart. I just want to show you that it could, with the news, it could jump up in there. If it trades above that, these relative equal highs right here, that's the draw. Okay, that'll be the draw throughout the day or into next week. Still not changing or upsetting the apple cart for lower prices in my mind, because I think the dollar's still bullish. This small little inefficiency is what we've traded into. And when you have your chart allowing for observation of these things like this, it's a little bit easier to see it. Okay, so That's what we trade up into. Look at your London session, study that, break that down, look for silver bullets, look for stop hunts, then displacement, and then a 30-second fair value gap. Those types of things are all throughout this morning, trading up into this inefficiency. Now, again, if you're the first time viewer and this is the first time you watch this video, if it's past the time I'm live streaming right now, or if you're watching the live stream live with us and you're seeing me talk about these things and think, well, you know, this already happened, go back and watch the live streams on Wednesday. Okay, I gave you very specific things that I wanted to see that day, and then what I wanted to see on Thursday's trading, we would be going higher. It's reasonable to see it trade higher. So it's unreasonable for someone to come in and say, well, you know, this is useless information because it's after the fact. When I many times before the fact point things out, whether it be on Twitter, you know, calling out levels, calling out what it should reach for, and I give you the context as to why I believe so when I'm doing the analysis or commentary over the charts. So it kind of it gives you like a comprehensive experience, as not just say, here's where I think it's going to go, because I'm not trying to provide signals. I'm trying to teach you a mindset so that way you can use the concepts I've freely taught on this YouTube channel. So that way you can go out and find your own model, your own setup, and be consistent with it and not require hand-holding by me or anyone else, which should be the target goal for every trader to have an independent mindset. All right, so like I said, we've been bearish through this whole thing, and it's been really nice to be able to see that happen. Yesterday, delivered like gangbusters, looking for a retracement higher. Real quick on cable, that was the wife yelling at one of my boxers. If you heard her, I'm not sure if you heard her or not, but she was pretty loud there hollering at her. All right, so here we have, let me go up to the weekly chart because this is not going to make any sense to you if you haven't saw those streams on Wednesday. This inefficiency here on the weekly chart, which is the week of March 13th, 2023. That's the buy side balance, sell side inefficiency, fair value gap, and trade down into that. I mentioned on Wednesday I want to see it trade down to the low of that inefficiency. And we got one little tiny, what's that, pipette or something below it. What's the high of this candle right here on the 10th? High comes in at 21, 13, and 7 pipettes, so 13.7. And the low of this candle comes in at 11.0. I'm sorry. Am I looking at the right one? Yeah. So it's just a little bit below it, but just as a candlestick tail, not the body. And the bodies are basically around consequent encroachment, which is the midpoint of any fair value gap or inefficiency. And Thursday, we see us trade higher and then follow through today. This wick, consequent encroachment, halfway point right in there, we traded right up into it. The inefficiency just above this old low. I'm not a support and resistance trader as much as anybody would like to say that I am, because they're trying to sell something that nobody wants to buy. This inefficiency right here is just inside a run back up into that low. So, you know, can it get up in there? I mentioned this on Wednesday, and this shaded area here is not a misplaced fair value gap box or something to that effect. I'm actually referring to something on the weekly chart, and I want to see this portion. And I know some of you are going to go crazy because I'm not talking about it, and this is the first video you watched. It's the upper portion of this inefficiency between this candle's low and that candle's high. This previous candle here, or week, that one big, pardon me, that one big candle moving lower one directionally, that range between these two candles, you know, bracketing it, I want to see this portion of that range stay unfilled. In other words, I don't want to see any price come all the way back up to this candle's low here. I don't want to see that. Because as long as that stays true, I believe that we're going lower on pound dollar. Can it go up here and reprice to that and then eventually go lower? Yeah, but the probabilities shift much further away from likelihood versus more consolidation and maybe even a deeper retracement into this one, which is why I like to see this stay open in this upper half. Okay, so that we understand the context of why that box is on the daily chart now, right here. So same drill. You want to look at what London did last night for today, and then what we traded and did yesterday on cable using silver bullets at the London session, New York session, AM, and then how we had price drop into this consequent encroachment of this wick here. There you go. So that's a nice, good study to do over the weekend if you don't have time to do it right now because you may be at school, work, or about to go to bed. And moving over into ES. Before I do that, let's just gold. Let's get gold out of the way real quick. I keep forgetting that extra U. All right. So the order block starts here at this candle here on the daily chart. So these two consecutive down close candles makes the bullish order block before this displacement to the upside. There is an inefficiency in here. So we talked about how this gap from this candlestick's low and this candlestick's high, which isn't drawn correctly, is it? Yeah, it's on there. It just looks weird. But the sell side below that, and then the inefficiency here, I wanted to see it trade to the completion of this. And if it got overzealous, I mentioned on Wednesday that we can get down here and touch the order block. We traded really close to, but we did touch the high of it right there. Okay, so the high of that candle, 1858.36, so 58.36, the low, 57.73. That's pretty close for gold. Gold's one of those, like a market I mentioned many times before, and every time I talk about it, it's a fickle market. That means it's event driven. It's going to mess around with you a lot. It's highly manipulated. Can you find setups in it? Yes. Do I have students that trade it predominantly, only, solely? Yes. Do I trade it? I don't like to. I just don't like to do it. But that also delivered handsomely on the analysis from Wednesday. In case I haven't made it clear, as I'm going through these, I'm not suggesting any of these have reversed. I'm just saying that everything that's in motion that I talked about on a higher time frame, I'm sticking with that idea. And again, avoiding trying to pick like the low on this. If the dollar does in fact resume going higher, like say it resumes next week or towards the latter part of next week, so something might happen on the 4th or something to that effect. And should that be the case and dollar starts going higher, just look down here, because right over here is where I'm liking the idea of gold reaching for that. Okay, so right below there is where I like to see intermediate term target for gold is down there. Everything that I talked about for those respective markets, I told you on the Wednesday live streams what would change my mind about it. So if you're wanting to know what would make me abandon these ideas, I covered that, respectively throughout the individual markets that I talked about. And ES, now we'll look at that. Oh, real quick. It probably didn't do it, but I mentioned I wanted to see Aussie kind of like upset its lows, and it did. So it went down, took those sell side right there, and then look at the reaction there. So there's buy side resting right above here. So if you're an intraday scalper and you want to use the news this morning, there's a couple things in here you might want to look at. We have this here. Overzealous price takes us up into that. Easy low-hanging fruit. Dollar moves lower continuously on the news at 8:30 and or 10. We could see 65.25. We'll call it that as a run for buy side. It's not a lot in terms of pips between where we're at here, but it's certainly something that you can trade with a demo account or tape read or study. I might be wrong. It might be one of those instances where you can say, ICT said this is going to happen, and it didn't happen. You can go around on social media and cheerlead it. So let's go over to ES. All right, so here is the E-mini S&P December contract. I want to try to quickly get through this because I do want to watch the 8:30 news reaction on NASDAQ and ES with you live. But I'll I'll close it around 8:45. The live stream, that is. All right, so I mentioned how we could come back up, retrace. I'd like to see these not taken. Like, I don't want to see these two highs swept, because I like the fact that we came up right to consequent encroachment on this wick. So half of that wick, it went right there. And then we had that turn, which is classic price delivery. We went over and overshot this inefficiency, and we traded down into the order block here, and I'll add that level so you can see there. We dug into that and into this inefficiency here once more, and I want to see it get down below here, but as I mentioned on Wednesday, this is a balanced price range, just like it was with the NASDAQ as well. A balanced price range takes a lot of energy to get through, and while the prices are always delivered algorithmically or by means of manual intervention, where a central bank will step in, or the hand, if you will, quote unquote, the market makers, not the ones that you hear named, okay, or have a title given to them at some kind of trading firm or whatever. They're not market makers, they're dealers, and they're dealing in a price feed that they don't make. So that doesn't make them a market maker, it makes them a dealer. So they're always misnamed, but the folks that actually originate price and deliver price, that's the central banks. That comes from them. That's the top tier, that's the beginning, that's the origin. When we see how price delivers to these objectives, when it's met with an area like this, back and forth, this is a balanced price range. So it's going to take a much more meaningful price run to get through this. Many times it won't do it on one single pass. So you have to allow for it to go down a little bit, come back up, go down a little bit deeper into it, come back up, a little bit deeper into it. So it's not always that way, but as a general rule of thumb, because I'm getting comments in the YouTube comments asking, how do you know when to read the balanced price range is going to break? How do you trade them? What's the insights that we can give to provide some more support around that? Just know that it's not a low resistance liquidity run to trade through a balanced price range. It is a low resistance run to trade to a balanced price range when you're above it and we're trading down. So since we hit it, we hit all of our objectives on S&P and more, it's reasonable to expect Thursday, Friday retracement, okay? But not call the bottom in the marketplace. That's really important, and I'm making sure you understand that part of it. And let's see, we'll drop down into a hourly chart real quick. I mentioned how we would go into upset these highs in here. We dug into that. We have a small little inefficiency right there between this candle's low and this candle's high. You gotta start moving your charts around so you can see them better. Some of you keep your charts so squinched, or you only show so many candlesticks. It's like you're missing a lot of the details, and the price comes down into that on Thursday with the expectation of what? What I was outlining on Thursday is that we would see price retrace and move higher, seeking what? Buy side. Why? Because they're going to set traps for traders that think that this is going down now, because they have all these days behind them where it's gone down. So now they finally get into the mindset that, okay, it's going to go lower. And I was taking your attention to the buy side. And there's a small little clean area in here. You might want to look at that this morning. And overzealous delivery will take us up into right there. Okay, so there's two things we could see price reach for this morning: 8:30 news and or 10 o'clock. So it could reach the 43.67. If you can look at something on lower time frames, the tape read that, study it, whatnot, it's something you can look at for today. And let's go back up to the daily chart and go to NQ. Okay, and this one here was the strongest between the two indices on the upside, so it's not surprising to see it be the laggard going lower. So while it did take out our relative equal lows, which we've been aiming for in this quarterly shift objective, which is this buy side imbalance, sell side efficiency, we wanted to see it trade into this big up close candle. We got down to it here on Wednesday, and as I mentioned, I said it could retrace. right above these relative equal highs. Go back and watch the video, folks, the live streams. But it could trade up into here. And again, I'm not trying to convey the idea that I believe that the low is in place. I don't suspect that it's like that at all. I think that, we've dropped a lot. There is an inefficiency here. There is a wick here that people that like to see things like this, they think that's a doji, it's bearish. They're going to put stops above that. It's perfectly reasonable. It's perfectly acceptable. It's common practice for the market to want to go back up, take a pool of liquidity out on the daily chart that would be opposing the longer term or intermediate term targets, which in this case, I'm submitting to you that we could still go lower. And I'm willing to allow the market to tell me I'm wrong on the daily chart, which is fine. I don't care. I'm not going to trade today. I didn't trade yesterday. So I'm waiting for more information. Why? Why didn't you trade? Because all of my targets were met. All of them were met. I'm content. I'm happy. I don't need to tell you anything more because it happened. And on the day that I wasn't going to trade, which was yesterday, I told you what to expect, and it's happened in your charts. So that's one of the things you want to get real comfortable with also, is being content with enough. So if you have an idea, here's a fair value gap, much like I was outlining on the S&P before we traded here. Real quick, the inefficiency on the daily chart is up there. Buy side, because NASDAQ can be a little bit accelerated and animated much more than S&P. 15,000, and here's the 830 news. So 15,028 to the inefficiency up here. Excuse me. Small little gap here. We drop down into that ahead of 830. A scenario that I would expect, but I'm not trying to sell you on the idea to risk money or trade your combine or try to pass a challenge on this. But let's play devil's advocate for a moment and say ICT was making the market for today. I would use the numbers that just came out now, send us up into, take out the buy side above 15,028, maybe trade up into here, and then at the consumer sentiment number, then send us back lower. Not to close on the low of the day, that type of thing, but to run against all the movement from today's price action, at least 50% of the daily range. If it gets up to here, I would do that very thing at 10 o'clock on the news release there. So there's just ideas for you to study, look at price action through that lens. It doesn't mean I'm going to be right. It doesn't mean that you should be trading with real money, but I'm just giving you something to study going forward, because I don't have anything I'm going to put money on today. I don't have anything that I think that you should risk money on, because it's Friday. It's a very good practice to end a good run with analysis, real trades, whether it's in your funded account challenge, whether it be in your funded account, whether it be in your live account, demo, paper trading, tape reading. If you had a good run like we've had for the last, months really, sit still, just relax, just settle down. And October's a really good month. Price action and delivery for October and the first half of November are just one of the sweetest times in price action. And we've had a lot of things move in our favor. So it's really important for you just to settle down and let the new opportunities present themselves. Don't be in a rush to get into what's next. Okay, this was great. I need another hit. This high is wearing off. My sugar high is wearing off. Give me something else to get all hopped up on ICT. So a neophyte, a gambler, a new trader always is excited about what's the next thing. A professional is minding rather their business, and also studying what they just did. Did they do all things correctly? Did they follow their processes? Did they follow their model? Are they feeling impulsive? Are they trying to chase a new high, a new equity high, a new emotional high, a new psychological barrier to be breached so that way they can feel like a champion? Professionally minded traders don't think that way. Neophytes, Instagram traders, the type of people, they are experience driven for the sake of the experience versus the sake of following the model and being sober minded in their decision making. It's a stark contrast between the two. And if you feel impulsive, if you feel excited about taking a new trade or finding a new setup, your mindset is not in its right place. It needs to be boring. It needs to be absolutely boring. And once you do all the right things all week long and the market's closed and you can't push the button and do something reckless or lose money or trade outside your model on the weekends, then you celebrate. Then you allow the emotions to come in because they can't influence you in a market trade. I'm not saying that you shouldn't celebrate, that you shouldn't peacock around and celebrate with your friends and family or social media, family, but do that in a area where you can't feel good or hear something that would be highly critical, and then you want to go out there and give yourself a feel good moment by doing something, by pushing a button that has nothing to do with your model. Okay, so that's the only reason why I'm coaching you to do this, and I'm certain that on Twitter somebody later today is going to say ICT said don't trade and look at what I did today. That's a weak-minded person. That's somebody that absolutely probably just did something cherry-picked and or doesn't have consistent profitability, and they just want to feel good about themselves and tell somebody else in a position that's acting as a teacher, as a mentor, something contrarian, because they don't want to listen to sound logic either. And to reward that rebellion, that rebellious mindset, they'll do something that they didn't really risk money on. But then they'll take that and they'll toss it in the ring and say, but look at this. Just like folks will say, I teach don't trade on Mondays or don't trade on Fridays. That's not true. There are many times I'm telling you to trade on Mondays. When is the time when you can trade on Mondays on non-farm payroll? That week of trading, that's a definite Monday trading day. But apart from that, the only other time is if there's a FOMC announcement, rate announcement, that type of thing later in the week, usually a Wednesday or a Thursday. That's a definite trade on Monday. That's a definite, absolutely, I'm going in there and I'm pushing a button. I'm trying to make real money. That's the way it is. That's what my students understand. But when you take one thing that maybe a sound bite or a clip or something I've taken and put into a tweet and you take it completely out of context, it's easy for these individuals to run around with these false narratives and say, I said this, or I said that, or this is what I believe about the market, or you shouldn't or shouldn't do this. So that's what being mentored is properly done. You have to spend time with that person that's teaching. You just can't watch one video or read a few tweets or an opinion or opinions of people out there that are failed traders and nobody really cares about their opinion, but they want to stir up drama for the argumentative side that would be opposing what is it I'm teaching or anybody else's stuff for that matter. That's why trolls exist. Trolls exist because they suck. They're not able to do anything themselves and they want to detract. So that makes them significant. So in these periods after we've had a really good run, you want to sit and really forge this confidence that it will provide you if you allow it by not chasing the next opportunity, because it might not be there today. It might not. It could be. It could be a huge run and be completely against what I'm suggesting that might be a good study here. It may not even go up to 15,000 at all. It might just, I'm sorry, 15,028 at all. This could have already made the high here at the 8:30 news. And then 10:30, we run lower and go for the sell side down here or here. And there it is. Okay. How am I going to lose any money on that? I'm not. How am I going to lose face and clout as an educator if that happens? I'm not, because I told you I'm not trading. And I'm telling you why I'm not trading. Because I'm content. My analysis has been bang on. Like it's been straight, right to the point, getting right to the targets, and it's been behaving like I've outlined. And you, as a developing student, need to sit and look at the charts and think about what we have anticipated before the fact and how it delivered. That is confidence building. It's not meant to be arrogant. It's not meant for you to go into other people's live streams or YouTube comment sections or their Twitter and tell them that they're trading something less than superior because you're trading with this information. That stuff needs to stop, because it's the same thing that I was just talking about. You're trying to create significance in yourself on the wrong pretense. Like you're trying to use this new skill set that you're acquiring, and you're trying to treat it like a sharp stick so you can go around and poke everybody with it. Nobody cares, especially if they're making money. They don't care what you're trading. If it works or not, they don't care. Because if someone's making money, they have a model. And if they're wise, they won't try to change it. And nothing's going to make them want to do anything to change their model. That's a professionally minded trader. That's what I'm trying to secure in your thought process. So once you get a model and you make it as simple as possible, you're not trying to bring all the moving parts that I offer in terms of teaching. You make it a very simple approach to trading. You know when you're looking for it, what time of the day you're trading it, what instrument you're going to trade, what market, what time frame. And you're just going to mind your own business and work in that small little area. And when you get a setup, you're all over it. If you have a setup and you lose, no problem. It doesn't mean the model's broken. It doesn't mean you go out there and get somebody to pat you on the back and say, don't worry, honey, it's going to be okay. That's not necessary. With a professionally minded trader, they accept the fact that there's going to be losing trades. They accept the fact that as the mechanic, the person behind the operator of the model, the person pushing the button, the responsibility solely rests on them versus someone that wants to blame anyone and everything outside of themselves because they're not personally responsible. So anyway, let's drop down here into a 5-minute chart and see what this thing is trying to do here. Yeah, it still could pump up there to that 15,028. Let's see if it will do it. All right, so see that wick right here? We're hovering right around the halfway point or consequent encroachment. The fact that this candle closed above it, I would like to see it not trade back down to the lower end or lower half of that wick. I'd like to see it expand up and drive into that level right there. And we're on a 5-minute chart, so okay, see how we're hovering around that? This candle closed above it. When I see that and I have an objective or a draw on liquidity that's likely to be a reason for the market to want to draw up to, and this is reversed too for when I'm bearish, and there's a big candle like this. When I see that, and then the very next candle I'm watching, whatever the time frame is, it's all respective to whatever time frame you're watching. So it's not limited just to a 5-minute chart. It's universal. It's something that I would expect in reading any time frame. So if I'm watching like a 15-second chart, whether I'm watching a 1-minute chart or an hourly chart, whatever time frame, if I have the draw on liquidity in mind that I'd like to see deliver, if that's what's in my mind, I think it could reach for, and we see a wick like this, many other traders would see this as scary and problematic, like it could potentially start to reverse. I don't subscribe to that view, and I get further along in my belief that the algorithm will reprice to those buy stops here. If this candle that's immediately after the wick forms, if it can close above the midpoint of that, it just means that there's potential for follow through. Now there's two things you can do with that information. You can do it as if you're a real short-term scalper, you can do things like this. Watch, I'll go into a 1-minute chart. And while price is hitting this right here, a real small, ultra short-term, high-frequency trading algorithm would be to be buying it when it hit here, and then using this high as your target. Just do like a half a point, since we're doing futures, like a half a point below that, your limit order would be there. And that in itself, you're doing more than most people on social media if you could just do that. You know, and most people don't have an ability to find where price should gravitate to, where it should turn around, what real support resistance would be looking like. And if you follow the stuff that's in books that classically define support and resistance, that to me is that's random. Okay, because there's so many different interpretations of what support and resistance should be, and they don't all behave the same way. And one of the things that I tried to do over the years is to try to create a language where I can communicate to myself in my journaling, and also when I was younger, expecting to be a father at some time, right? If I had children, how could I talk to them and communicate a way where these candlesticks tell a story and there's a narrative behind what it is that they're doing. And that way we don't fall victim to just, moving around for the sake of, short-term randomness. Because I do believe, like, in very, very small time frames, when in consolidations, that's where, I guess, quote unquote, randomness can occur, because during those periods, it's time distortion. And time distortion is where the market is not being permitted to move. It's not being allowed to displace higher or lower and start running. So in these very, very small time frames, sub 5 minutes or whatever, and you get these little consolidations in price action, that is time distortion. It's being held for a news event to hit the marketplace. It's being held for a session close. Like if you watch how the last few minutes of trading, after 4 p.m. in the New York session, many times you'll see the market just start marking time, basically just going sideways, isn't doing anything. That's time distortion. The algorithm is not operating anymore. It's just, they set a range high and they set a range low, and they just let it meander back and forth. It's not seeking liquidity there. It's not going after anybody's stops. Buying and selling pressure has no influence over it. It's just simply limiting its range in delivery. That's it. It's done. But during market hours, the algorithm will absolutely be seeking liquidity. It will be running off of macros. These are short little scripts in market code. Okay. And all these things will be firing, causing price to move. And it has nothing to do with how many people bought it or how many people sold it. All right, so look at the reaction there. We went just above that wick here, just by a little bit. We're pulling back. And now look at all of this run here. Look at all this price delivery right there. Is there any inefficiency? Let me make it a little bit larger so you can see. From this candle's high right here down to that low, is there any inefficiencies in price? Fair value gaps is basically what I'm saying. From this candle to this candle, no. From this candle to the left, no. From this candle to the left, no. From this candle to the left, no. From this candle to this, yes. You see it? That small little one right here. See that? This is the only inefficiency in this price run here. This one's kind of like the same. Let me see what the high is on that one. High is 80.5. Low is 8, and it's even. So there's no inefficiency or no gap there. So it's an immediate rebalance, which is perfect for me to segue right into that. Started the run here, open, traded down. Whenever we see this is one of the things I teach. It's an immediate rebalance. You're not going to see that in any kind of books. Chris Lurie don't even talk about it. I know a lot of people try to say I teach his stuff. It's not, and you don't see Chris Lurie coming out here doing this. But that is an immediate rebalance. That means it's as soon as it does that, you're going to see sudden price delivery, real quick. You tell me. Okay, does that look like it once it gets somewhere after it did an immediate rebalance? Of course it does. Where's it going to go to? That high. We can anticipate an entry here, a pyramid entry here, or if you missed this run, as I outlined live, that it's consolidating around that consequent encroachment of the higher time frame candlestick wick. That's what I was measuring on that. And came down, hit it, rallied up just to take out the high. It did so here. No inefficiencies at all. And I want to see, personally, I want to see price stay above consequent encroachment. That'll tell me this is where we're going to run for at the 930. If we break down below it, then it's probably going to need to trade into this area here, which is of no consequence to me because I could care less. But like say I was trading this morning and I wanted to trade the New York opening bell at 9:30 to 10 o'clock, and I wanted to do something, okay? Or I wanted to tape read, okay? Or I wanted to do a demo account execution for practice, and I don't want to take real risk. Or I just want to sit down. My youngest son's not with me this morning, but if I wanted to sit with him and practice executions or reading the tape with him, I would use the information I'm showing you here. For 9:30, for this run up here, the higher probability trade setup would be for price to stay, and it can do what it just did there. It can wick down below that, but just I don't want to see the close of that candle. See where it stopped? See that? See how it stopped right there? That's good. I like that. But if it traded down and closed below that, then this is a factor that needs to be revisited. But that right there, that close, and look at the reaction right there. That little response right there, that's an algorithm that's doing that. That's not buyers and sellers, okay? That's these things I'm talking about. That is a signature in price. And when you know where you're supposed to be expecting them to form, when to anticipate their delivery, what they should be performing, what should they offer in terms of support or resistance, should it incite the algorithm to start repricing to a specific direction or a specific price level, and these PD arrays in the right narrative, so that way when you understand what price is likely to do, it'll tell you how fast it should deliver. Like, should it be a slow meandering delivery where it just keeps on creeping, or does it go like, well, runs real quick and takes off? That part, like, I can't write a book that's going to be able to clearly show you that. Like, you have to see it live. You have to see examples of it. And when I do executions, even when it was in demo, the purposes were for you to go back and study and see where those things are that repeat that I teach, and how is that used in price for that particular trade. What elements of the things that I teach in price action were in that trade setup that I took. And for a long time, people were complaining about how it's demo. It only works in demo, apparently. And then I started trading with a real account, and then there's crickets. So you're never going to be able to satisfy everybody. So I like the idea that this candlestick came down just about half of that candlestick. That would be mean threshold, because we're talking about a body, so it's not an inefficiency. But because it's Friday, because it's a day I'm trying to remind you not to take this stuff, because I know some of you right now are pushing buttons because you hear me talking, and you are being convinced that what I'm saying here is just enough for you to get into a trade. I'm telling you, don't do that. Don't do that. This is the part that I didn't want to do this morning, but I'm trying to be generous to you because I wasn't with y'all yesterday. In a perfect world, it should run higher right from here. If it were, say, it was a Thursday, not Friday, I would already be net long, and my limit order would be just below here, and I would have a best case scenario up into this up here. That's how I would handle that. But it's Friday. I'm not trading it. I'm not live. You're not going to have here's a dose. I was secretly doing my trade. I'm not doing that here. I'm just telling you how to read, how to practice it, and use the day without taking on risk. The best case scenario would be to stay above in this range here prior to 9:30. And if it does that, then I would like to see price run this area here at 9:30 or just after 9:30, going into 10 o'clock. But then at 10 o'clock, I think that we could see it retrace, throughout the remainder of the PM session and go lower and attack all the price delivery that we've seen so far from the London hours all the way through to pre-market. Some of you folks just thought that it was going to be, I'm going to open up an account and I'm going to be able to just walk out here and start making money. This is going to be easy. So a lot of things you got to weigh out in it. That's why it's difficult. It's the hardest easy money you'll ever make. Now, another thing for your notes today, whenever you have two high impact news drivers, apologize. Whenever there's two high impact news drivers in the same session, like we have an 8:30 news driver that just has already hit the market at 8:30, and then we have one at 10 o'clock. Whenever that happens, whenever that's in the economic calendar, my mind immediately goes to, in case you're wondering, like, why would I say 10 o'clock news should be used to go against everything that's going on? Think about it like this. If a terrorist was going to lay a bomb down, okay, and they do it this way, they go into a busy area where a marketplace or a storefront, and they set a small charge up. And when that charge goes off, what's going to happen? Everybody's going to run away from that point of impact, right? And they all run to a location where the larger bomb is, so that way there's more casualties. Okay. In my mind, the way I internalize what they do is much like what I teach with FOMC, much like I teach with non-farm payroll. Those are financial bombs. Okay, they're literally placed in the marketplace. They're algorithmically delivered, and what happens is one news driver sends price, careening one direction. That's that first explosion. Okay, so at 8:30, what did price do down here? Running, right? We have a potential pool of liquidity up here where price could gravitate to, right? And I'm suggesting to you, as long as we're in the upper half, as long as we're in this area here, going into 9:30, I favor the idea that we could run up in here and sweep that out, and on some kind of momentum, overzealous price delivery, best case scenario would be up into this area here, this inefficiency on the higher time frame. But I'm not willing to take that trade today because it's Friday, and it's going against my mindset about I'm content with what I've done. And if I did something this morning and it wasn't profitable, or if I outline something and call it like on Twitter and it doesn't pan out, it'll be in my head all weekend when I knew I shouldn't have touched it. I shouldn't have done it. So hearing me talk about it live over the chart, that way it gives you a little bit more understanding of why I'm not taking the trade, but I'm also using the opportunity to teach you real time what I would do if it was, say, like a Thursday where it wasn't the end of the week. Okay. But that 10 o'clock news driver and price running up to this level here and maybe spiking up beyond it to get into this inefficiency here, I would use, if I was making the market, I would use the 10 o'clock hour, that news, and the sentiment after seeing traders see it, rallying from 8:30, and at 10 o'clock, we see it going higher. What is the public going to do? What's the street money going to be thinking? Street money is going to be like, I want to be long, right? I want to be long. That's the very logic that I used on Wednesday to explain to you why we're trading where we're at right now through Thursday and now Friday's initial trading. Because I'm waiting for those wrestling matches when the sentiment of retail, the collective that is called retail trading, the street money, the quote unquote dumb money, and I don't mean that to be ignorant, but that's just what it is. I mean, I came from that too, right? Everybody is that when they first start. I'm waiting for the time period where what I'm anticipating that the algorithm will do, how it runs on specific narratives and its macros and the time of day it does certain things using the economic calendar, just like a TV guide. Okay. You can anticipate the sentiment shifts that the retail trader and collectively the traders will think and how they will perceive price before it even happens. So you're really not only predicting the future, but you're reading other people's minds in the future, which is an amazing skill set to have. And that's why this industry is so fascinating, because it's really a study of psychology. It's more a study of psychology than it is of a game of chance or risk. And I think if you approach your initial stages of learning with that mindset, that approach to internalizing how price is being booked and why it would be booked like that, what would be the instigation of price doing a specific thing? What would be the catalyst? What would be the driver of it doing that very thing? What would be the cause and effect? What would be the repercussions of price doing a very specific thing? And how would the losing crowd, the retail-minded trader, how would he fall victim to it? Because that's what this game's about. Every large fund manager is still a retail trader. They're literally trading with retail concepts. It's amazing. When you sit down and see what they're doing the same stuff that everybody has in these books. They're just doing it on a larger scale, on the higher time frame charts, and just allowing for more time to eventually move the market in their favor. That's all that's happening. Now, the proprietary firms out there that have their own algorithms that they're running in the marketplace that trade off of small short-term fluctuations in price action, they are not using retail logic. They're using a lot of the things that I'm talking about here today. The framework is around how they can get in, take bite-sized pieces. Okay, there's a fish, and I may not be saying it accurately. I don't know if it's considered a small shark or whatnot, but in the ocean, there's this little tiny, I'm just going to say fish, okay, but it might be technically a shark. What it does is it runs up real quick on everything out there. It'll do it to a killer whale. It'll do it to a blue whale. It'll do it to a shark. It'll do it to a paracuda, any fish, a tuna. But it runs up real quick and bangs into it, and it takes a perfect circular bite out of them. And that's all it takes. Hits it, runs. And you can see other fish and other living organisms in the ocean that have been eaten by this thing. They're not consuming the entire thing. And the wound isn't many times a fatal wound, but they're losing a piece of themselves, and they sustain themselves by simply going in and getting one bite. That's what these proprietary algorithms do. They go into the marketplace to take these little bites here and there at points that when the market makes it available to it, it will work and engage it that way. Whereas a long-term large hedge fund manager, they're not looking for these little surgical strikes. They're looking for big, long-term, massive price swings because they don't want to have their clients constantly calling up, hey, what are you doing? Like, my equity's going up and down a lot. They don't want that. They want a very, very slow, smooth equity curve. And if it takes all year long to get 15 to 25%, that's exactly how they want to engage price. They want to engage and utilize their assets under management like that because they don't want their clients to be hopped up on goofballs or fearing and freaking out because of the normal fluctuations in price action. We as a speculator, when we're watching price action, whether you like to believe it this way or not, but this is the reality, you are inviting roller coaster volatility. You want that. You want to see that. And you're okay with seeing your account going higher and lower because you're anticipating that eventually you're going to get to a big explosive price run that you'll be hopefully on side and capture that big run. And it'll be profitable for you. But what you end up incurring is a lot of those little tiny little fish that they come up there and they bang into you and they bite your account. And then you make a big to-do about that and you think that's failure or you get mad about it. Like, I'm the only one that can come in here and take it out. I'm the only one that can take the profits out. Nobody's allowed to take anything from me. That's not realistic. To go into this industry thinking that you're not going to have a little piece of your ass taken here and there is unrealistic. So you have to accept the fact that you're going to get bit. You're going to get chomped on. You're going to might miss a limb here and there, 1 week out of a month or half a month. Or you might just get through the month and in one day get you back to break even. You know what that means? You're a better trader than most people out there because most people are net loss at the end of the month, at the end of the week, at the end of the day. As soon as they get their live account, they're done because they don't know what they're doing. So it's really important that you have realistic expectations, that you give yourself the time required to learn this, and don't put so much emphasis on being perfect in the beginning, but also learning how the market should book and who would be in the position to gain by a market delivering a specific way, going to a specific high. Who would get hurt there, and why would them specifically being hurt at that time, how would that be used advantageously by another group of speculators in the marketplace? What would be that narrative? So I try to teach that to my students, and I'm trying to teach you the building blocks of it here. And there are going to be days where it'll look like it's wonderful, where the opportunities are going to be bountiful, and as soon as you get in the marketplace, everything goes fuzzy. And it becomes uncertain. Your model doesn't look as so one-sided as it did before you put the trade on. In those instances, as soon as you feel that, okay, and if you're new and you haven't been doing it for a long time, the first thing you should do is immediately cut the risk in half. If you can't do it because you're only doing one of the smallest lot sizes or contracts, then close the trade. It's not beneficial for you in the beginning, early stages, for you to wrestle through uncertainty and spending not only the capital that's in the account, whether it be demo or a combine or a funded account or funded with a funding account company or live funds. It's not worth doing that in the early stages, because that damage, where it's reasonable to expect that little tiny fish to come in here and take a chunk of your ass and you lose something. That's this business, folks. You're in the ocean now. When you're in here and you're trading, you're in here with other things that have teeth. And you're going to lose limbs, fingers, toes. It's going to happen. Okay? And you're going to have to still find a way to swim. Or you're eaten, or you're going to sink. And then when you sink, the bottom feeders will consume you. But you can't escape, something not biting you eventually. Having this mindset that you want everything to be one-sided on your trades. And as soon as they become potentially not so one-sided, the first rule of thought should be, okay, number one rule in trading is preserve capital. That means, okay, this trade is not so obvious to me right now. It looked really good. It wanted to go to this specific level, but now it hasn't done so. It hasn't performed that way, but it hasn't really done enough to make me think that it's entirely wrong. It's just I'm a little unsure about it now. When that happens, cut the trade in half. Or if you can't cut it in half, close it. And then observe it, study it. Don't walk away from it thinking, oh, whatever, or get mad about because it didn't deliver like you wanted to. Watch it. Still try to get the experience from it with no risk. If it moves in your favor, okay, great. You kept yourself from spending mental capital, which many times is much more important than the actual capital in your account, because that can easily be replaced with working a second job, putting money from your savings into it. If you have a business, taking something that you sell and applying it to your account. That part's easy. You know what's hard? Getting back the mental capital that you caused a deficit in bankruptcy, of completely not trusting your model anymore because of one event, which one event doesn't change or upset any model, in my opinion. I don't care if it's even retail stuff. One event, one losing trade, one transaction that didn't pan out doesn't undermine the efficacy of anything. But many times you're going to find out, and you probably are, if you agree to me being honest right now, you would think that this is what you're wrestling with right now. Whenever you have these short-term adversities, you think that everything's changing. The algorithm's changing. ICT's got too many students now. They're changing the algorithm. No, they're not. They're not going to do that, okay? Trust me, they're not going to do it. The markets will stop. They won't be available to us to trade before that would ever happen, okay? You're literally talking about the underlying mechanics of how prices book. They're not changing it. It's the way it is, okay? All right, so we have one candlestick down here that closed below it, and then we have this one here. I mentioned how it could draw down to that little tiny little inefficiency. It didn't touch it. I would have liked to have seen it hit that, actually, personally. But, it's Friday, right? It's Friday. All right, so it's about 9 minutes almost after 9 o'clock. I'm in overtime with y'all for free, like that. All right, so see how many times we've poked above here, 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 here. No bodies have been allowed to breach that high, just the wicks. Now, in my mind, you see this here? Some of you might see that as the model 2022, where it's a shift in market structure here, going up into a fair value gap, sell short, and then wait for it to keep going down lower. I would not take this trade using that logic, even if it does deliver and say it goes lower. I don't care about that because there's a 10 o'clock high impact news driver looming. It's Friday. The idea that it could squeeze up there even more, and why would that be advantageous? Because longer term, the market has been going where? Down. The last 2 months or so, or month and a half, we've seen lower prices. So if we are in fact, and let's play devil's advocate for a moment, just for the sake of this discussion, let's just say I'm right just this time, okay? And we do go lower, longer term. Say in November, we're lower than we went to on Wednesday of this week here. If that's the case, and say, for the sake of discussion, that I'm right and it goes that lower price into November and we go lower wherever, it would be advantageous for the market to go above these highs here because it would do what? Run buy stops. Why would that be advantageous? Because those buy stops could be used for what? Short entries. For folks that want to do what? Build in positions that eventually will be underwater for longs, but profitable for them if we do take out Wednesday's low. So I use that idea and thought process coupled with the fact that we have two high impact news drivers in the same session. Whenever we have that, there's like this two-stage delivery. One's used to spur on a move or continue something that like we've seen since London. What is price done in London? Okay, 3 o'clock in here, we rallied, came back down in to an inefficiency. I'll go back up to a higher time frame and show you what that is in a moment for those that don't know, remember what this is. Then we rallied again in between 7 o'clock and 8:30. News driver comes out 8:30. What is it used for? To continue what has already been in play since London. Okay, that means supercharge it higher. Wonderful, great. But we still have what? We have that 10 o'clock news, and it's Friday. So there's a lot of maybe you couldn't be right, but maybe you can be wrong. And I know that these are days that because it's two market drivers, I might not have the second at 10 o'clock pegged. They could use 10 o'clock to send it through even higher because it's Friday, because they want to squeeze up into all the trail buy stops, because that's where liquidity would be for someone to buy it from them at a higher price. Smart money, if I'm right and we're going lower than Wednesday's low this week, if I'm accurate on that assessment, that belief, that opinion, and I'm not trying to make the case that I am right. I'm just submitting to the idea that what I do and how I'm reading price and how I use the economic calendar. And when there's two drivers in the same session, we're not talking about a high impact news event at 8:30 and then something at 2 o'clock. There's two of them in the same session, the morning session, the AM session. Because of that, my concern is that they used London to send it higher, which was in sympathy of what I outlined Thursday would be, which would be a retracement higher. 8:30, They send in more volatility and sends it higher. And now we have that looming 10 o'clock news. So I would not want to trade ahead of that because it can be utilized as I'm outlining here. I am completely content with being wrong. If I miss a move, I'm content because I'm trusting the logic and I'm not going to feel, oh, I missed out on that move. Where some of you might think that's occurring because maybe I've done something in the past where I said, I think this level's going to trade to, and it doesn't do it. Oh, ICT's FOMO right now. No, I'm not. I don't care because I know what I'm looking for and I know when I can potentially be wrong. And if I am wrong, it doesn't change anything. It just means that that was nothing for me to take money out of. I couldn't use that for my advantage. I couldn't use that for a means of harvesting any profit from the marketplace. And being right or wrong has zero to do with trading profitably. It has nothing to do with it. But in the beginning, you equate that that's what this is. Trading profitably is being right, when many times I've made money being wrong. And that's the skill set that you need to be working towards. Saving and keeping money in your account when you're wrong. How often have you thought about doing that? Think about that. How often are you thinking about preserving capital? Many times you're not. You're thinking about it when you're in a trade with a trade that you didn't put a stop loss on, wishing you would have. Then you're thinking about, man, I wish I would have preserved some capital and used a stop loss because I didn't want to see this happen. I thought it was never going to happen, and it's done run 40 handles against me. And it could probably keep going up and up and up. And in your mind, you think it's going to go up 500 more handles. The likelihood of that happening next to zero. But in your mind, because you're doing things wrong and you're thinking now toxically, you start inviting and entertaining these unrealistic, scary thoughts. And you wonder why you don't have any discipline, why you can't follow a model, because you're inviting the very things that is going to undo you as a trader. All those things that you're fearful of, they're easily managed. And some of the things that you think are likely to occur to you are probably never going to happen. But I promise you, if you don't have impeccable risk management, I promise you, if you don't use a stop loss, I promise you, if you over leverage, you're going to blow your account. Even with my material, even with the precision stuff that I teach, all these rules, you still run the risk of undoing yourself because of the character flaws that you'll bring into it. And you'll put more precedence on the things that matter the least and not concern yourself with the things that matter the most. Preserving capital. If you had your account throughout the year, okay, you could lose a lot of losing trades. But if you were in the game long enough to let the good trades that you would eventually been in to materialize, you can be profitable. But if you don't think the way I'm talking about here, if you don't think about preserving your mental capital first, so you have to be comfortable in the trade. You have to be content with what it is you're doing. There's nothing better that you need to be worrying about. There's no other market that you need to be worrying about. There's no other time frame that you need to be worrying about. There's no other setup, no other model, no other ICT post, no other tweet that I'm going to be making, no other video, no other instructional thing. There was nothing missing. Oh, I should have watched this other video. I literally just retweeted some guy asking some other student, what was the most important things out of the 2023 mentorship? And I'll summarize what he's asking, or she, I don't know if it's a guy or girl. Give me a shortcut. I don't want to waste my time. Don't watch my stuff. If that's the mentality you have, don't watch any of my videos because you don't have it in you. Okay? You don't have it in you. That's a weak-minded individual. You want something real quick, have it your way mentorship, dollar menu mentorship. You're seeing a drive-through. We're not McDonald's here. I'm not a clown teacher mentor. I'm somebody that's teaching some people how to really make real money. And there's a lot of rules and there's a lot of things you have to go through. And it's going to take time, more time than you probably want it to. And the people that ask the shortcut type questions, I mute them. Like I retweeted them, but he's muted now. I have no tolerance for that. I have zero tolerance for it. And they can talk shit about me, call all kinds of names and whatever. I don't care. These people don't want to learn. They want a magic trick that they can go out and perform and impress their family and friends and, and have overnight success. And trading's not like that. It's a lot of things that you have to weigh and factor in. And a lot of people are not equipped. They're not equipped to speculate in these markets, to manage risk. They can't even balance a checkbook, let alone go in here and try to balance a trade from beginning to end. Many of you probably don't even know what's in your bank account. You got to go and sign into your bank app to see how much money you got. That's scary. And if you think about it, that's scary. But you all want to have a profitable trading journey. You're not even financially responsible in your own little money, and you want to make a lot of money. All right, so we had one small run that didn't get down to a level I would have liked to see here. I would have liked to see it hit that small little inefficiency. Remember, I was drawing it out here earlier. Right there, that small one. There's a volume imbalance right there. I didn't notice it until we just did that. So if we overshoot this, say it drops one more time, say it goes into here and overshoots it, this little tiny volume imbalance right there until we get down to the immediate rebalance there. That could happen. It could get a little whipsawy, but ultimately I want to see how we behave 9:30 into 10 when that news driver hits. I'm not staying here for that, by the way. You're like, oh yeah, ICT is going to be with it. No, I'm not. I'm looking at the time now. I want to try to escape here. I'll watch the opening bell. I'll give you 5 minutes, but I want to be in my own mind, not messing with anything. You're not going to get any dose later on. I just want to see how it behaves and not be talking about like I'm doing now because this is a little distracting for me. So if you're in this trade, okay, I'm saying trade, in quotes because I outlined this as maybe some of you interpreting that as the model 2022, where we take buy side here, shift in market structure here. Here's the inefficiency. It's above equilibrium. So it would be in premium. Trading into this area here, you might look at that as a short. And I said I would not be interested in taking that because of the 10 o'clock news driver, because it's Friday, because it's rolling against the underlying sentiment that we've been bearish. So it's reasonable to anticipate them to want to take price up, to buy stops. To run those buy stops, allowing smart money to build in positions selling short, and they can sell early. Okay. If you looked at the lesson I gave on the commodities portion of the core content, and for the life of me, I don't recall. Man, don't take my word for this one, okay? But I want to say month 10 core content, but I'm probably wrong. Okay, so I'm probably calling it the wrong month. But the one I talk about commodities and I go over commitment to traders, and I teach how the smart money and those large long-term hedgers, they'll sell as the market's going up. They're selling into those rallies. Okay, think about what we're seeing in the indices right now. We've already dropped a lot. It's perfectly reasonable for, as I was outlining on Wednesday, for the market to go higher Thursday and then Friday. And we've seen that happen. Why would that be advantageous? Because if the market can go up higher to knock out people that are profitable right now that trail their stop loss lower, their buy stop gets them out at whatever profit or loss that books at the time their stops are executed. The other side of that execution is a short seller, in my mind, that wants to establish a short position for the longer term. So you're looking at markets like in terms of a pattern. My harmonic wombat pattern says it should go up to this level or it should go down to that level. Okay. Or you're looking at some kind of indicator that says that, price should do this or do that. I'm looking at price and thinking, okay, why would price want to go to that level? I'm not a fundamental trader, but I'm fundamentally light years ahead of everything else because I'm looking at the context of why price should be booking the way it does. You all figure out a narrative when you take your trades and you get stopped out. Oh, they did this. You figured it out. You know exactly what they did. You always say it out loud. You bitch to yourself. You bitch on social media. You bitch to me. You bitch to people in your YouTube channel. Oh, they so and so, those market makers did this, they did that. It's clear because this happened to you. So what I try to do is I try to be ahead of the curve and say, okay, I am the market maker. I want to take these people out and I want to take their seat because I'm booking price lower in a later time in the future. I want to use these people right now that have buy stops that want to buy it at a high price. That's essentially how I'm using their orders that they see as a shield that's protecting their short position. I'm going in as an apex predator. I'm going in like the alpha wolf, and I'm going to consume you. You're meat to me. I'm going in there and I'm going to to sink my teeth into you and devour you because you getting out with a profit or you getting out with a loss matters not to me. Your liquidity. That's all you are. You're just a meal. And I have to use you as a stepping stool to get to where I want to go. That's what market making is. That's exactly what it is. It's not allowing and facilitating trade. It's consuming. It's consumption. It's the survival of the fittest, the apex eating the lower ladder. That's what this market is. That's what it is. And there's a lot of fanciful ways to be able to try to sugarcoat it and make it sound, something that it's not. And then you wonder why everybody has a losing track record. They have a inability to find consistency or find a rhyme or reason in why price behaves the way it does or shouldn't do. Let me ask you a question. If you would have took that short in this area here, would you feel comfortable with it right now? It still could work. I'm not going to argue and say that it can't still drop. But I'm saying right now, if you were in that trade, and I'm sure quite some of you are probably in them, and you're thinking, damn it, I should have listened to ICT. Who knows? I might be wrong. It might just drop down here and go below this lower here. It could happen. I could be wrong. I'm completely accepting the fact that I might be wrong. I'm inviting it. I'm allowing for it this morning. But I'm also telling you one side. I don't see it that way right now. I think that they're going to use that 10 o'clock to run even higher for the purposes of sending it higher to sell short into, and in 2 weeks from now will be lower. That's how I'm trying to articulate the thought processes how I'm looking at price right now. Personally, if I would have used this pattern here to get short, it's highly unlikely I would have done it because these are too enticing. Like I think this is just asking. Please come up here and take my buy stops. Please come on up here and let me get knocked out. Okay. Or traders that are seeing this as a bull flag, they have their buy stops here to be buying long. They want to go long there. And if I'm accurate by what I'm suggesting, and if it does pan out, the shorts that have buy stops here for protective stop loss purpose only, if they run that, they get stopped out at a loss. The folks that use this idea here as a bull flag, they have a resting buy stop to enter long, to get long, to be net long. I think that at 10 o'clock or 9:30 into 10 o'clock, the run into this area may be higher. They will be in short-term unrealized profit that I think eventually would be a cause, a reason for them. Let's assume that, say these two lows here stay intact and we don't go lower than that prior to 9:30. Okay. Or if we drop down there at 9:30, then I would anticipate price then reaching up here post 9:30. But assuming these stay the same, okay, and in 9:30 we run higher here, that trips in the retail traders that use a breakout strategy to go long. So their buy stop is their entry mechanism. That's their order to get in, not a protection behind a short position. It's an entry for a long position. They would be allowed to be in unrealized profit, but if they use the idea that I'm outlining here, and I might be wrong, it could just keep on going higher or never go up here at all. But in my mind, I'm thinking even if they get in, they will have a short-lived objective. And if it starts ripping up to this level here, they're not going to want to get out because they think it's going to go to the moon. And then eventually at 10 o'clock news will come in, and then maybe there will be a sentiment shift that is used against them. And it starts raking them across the coals and goes down below these lows here, and they are no longer profitable. Consumption. Would you be comfortable with that short right now? Looking at the time, we're about 95 seconds from the opening bell. Would you feel comfortable in that short right now? With pools of liquidity here and here. I wouldn't be. This is also a time when I would not be in trying to early entry, because sometimes you'll see me enter before or right at 9:30. This is one of those instances where I wouldn't do it because of all the things I've talked about this morning. Now, you want me to be able to condense that in a 5-minute video. I ain't got time. Listen to this guy. He talks too much. I just gave you a clinic on stuff that you can't find in books, and no other mentor is going out here doing it and talking about it. "30 seconds." And this is where you want to be at in the early stages of your development, where nothing can hurt you. Nothing can cause any kind of pain. If you're right or wrong, it matters not. You're studying. You're looking at for the purposes of understanding the logic, understanding narrative. How does the market use the existing orders that are above and below the marketplace on the day and time with an economic counter like we have today? 9:30. Shorts are gone. Longs are net long. Told you, it was not model 2022. Not bragging, but I'm just telling you, there's a reason why when I pick trades to talk about or call levels beforehand, why I'm so accurate. I'm filtering out all of these types of scenarios. I'm filtering them out. I'm not going to fall victim to these types of things. That's why everything I talk about in Twitter, when I'm calling it, that's why it's 100% almost likely to happen. Not always, no. But most of the time, the high 90%, that's why it's working all the time. So we've seen the short-term buy side taken here. Remember where the sell side is right here? And that little imbalance here, and that small little volume imbalance, which I should have on the chart. Let's put that there real quick. I'll just highlight the low of it. So it can sweep below here, hit the small little fair value gap there, and that low of the volume imbalance right between these candles' bodies. That's what I'm showing you, in case you haven't studied what a volume imbalance is by me yet. It's the separation between, let me take this off. It's the separation between these two candlesticks' bodies. They can be linked with the wick or wicks, but the volume imbalance is the fact that there's no overlapping or touching of the two consecutive candles' bodies. So I'll add that back. See how it's whipsawing? Why is it doing that? Because you have a news driver that's the second one in the same session. 8:30, the news embargo lifts. That starts technically the morning session. Like you're in there watching what it can do based on the news drivers that come out at that time. Then you have another one at 10 o'clock. So we already had sentiment in the marketplace from London and from yesterday. It's been what? Short-term bullish. And then we had 8:30 news send it where? Higher, even still. Now we have the opening bell at 9:30. We've cleared the buy side. We've killed the shorts. Now, short sellers that want to sell in the breakout, they now have been engaged right here. I'm going to take this rectangle off because it's already done what I needed to do, and I'm going to take this off because it's already served its purpose. So I'm going to show you, this is where buy side is at the moment. Watch the consequent encroachment of the wick. We want to see it close above that. If it closes above that, we'll expect follow through. The reaction off of that fair value gap right there I mentioned, that in itself is a high frequency trade. Look at the candle's low up here, right up here. This candle's low is 14,985.75. The low of that candle comes in at exactly at that price. That's perfect. What did I tell you? Who was put in the marketplace below here? Shorts that want to sell on what? A stop. When's the market going to chop where you can't trade it unless you know what you're looking for? How are you going to get hurt? When is it going to be consolidation that will get the live streamers complaining about, oh, this chop is killing us, it's beating us up? It's this. You have to know when these days are going to form. You have to know when it's likely to form, so that way you don't fall victim to it. It's allergies, man. The way you would use this one here is the same way I mentioned earlier. As it hit down here, it's taking sell side, these lows here, trading down to the fair value gap that I outlined real time beforehand, and then it stops right to the tick, turns around and runs consequent encroachment. It doesn't need to take this high out. Is there enough range in there to take 10 handles out? Yes. Is it something you should trade today? No. But it's something you can journal, you can observe it, you can log it. If you're following along today, and this is not one of those exciting lessons where I explain something beforehand and the market explodes and moves in a directional bias at a fevered pace getting there. But this is the stuff that you want to learn. This is the stuff that I wade through and I don't talk about on Twitter. We don't ever see these types of conditions when I'm chit-chatting and calling a specific move or a level. It's never in these conditions. Have you noticed that? Because that's the key takeaway this morning. Why am I so accurate? Because I don't talk about the times when it's like this, because it's what? It's much more difficult. It's 50-50, one way or the other. It could do either one of them. And you don't want to be in a situation like that risking real money. You want it to be so one-sided that it's obvious for you to expect it to behave a specific way. Now, if it was another day, not Friday, and we didn't have the 10 o'clock news, I would be selling short right there. As soon as it hit that low right there, I would have done it there. Looking for a run below here, first partial, and then I'd look to see if it could accelerate. I'm not saying you should do that. If you remember what I said if it were not Friday, if it was like Thursday or any other day, based on this and we didn't have the 10 o'clock news looming, I would trust that right there as an immediate rebalance and look for lower prices. But based on everything I've outlined here, that's why I'm on the brake pedal. I'm not even, the engine's not running today. Like it's in neutral, park, whatever it is. The keys are in the house. I'm not driving today. I'm just sitting here talking about something over the charts with you. Hopefully reaching you and giving you a reason to not want to feel like you got to be doing something every single time. Because if you don't know what you're looking for, or if you can't identify quicksand, you'll fall victim to it. Now, any day but Friday, without that looming 10 o'clock news, if I saw this price action right here, I would not be interested in holding the trade. The short that I would have used at the immediate rebalance there, I would kill it because it's already traded above equilibrium of the range. I don't want to see that because if it can trade that quick back to the middle part of it or equilibrium, then it can easily punch through, go to the other side. So these are all things that, now think about what I've already talked about. You're going to want to watch this video a few times this weekend and going in the future, because these are things that they can't be taught in a book, and I can't teach it in a 5-minute video. Like it's impossible. Nobody can condense everything that I'm covering here in a small little sample set of choice words, and then you're going to understand it. It doesn't work like that. I wish it could. It would save me a whole lot of time. So in here, all this price action back and forth, the only thing I'm looking at, and I don't trust it, the only thing I'm seeing is that initial gap here, drawing that out in time. They keep using that. I don't trust that it wants to keep going lower, because in my mind, this should have already went down below that low. This feels like they're sending it lower to get people wanting to go lower. And every time they go lower, more people are going short. That just builds the buy side up here bigger. So this is like, in my mind, I see it as engineering more liquidity above the highs. All things equal, if you hadn't trade, if you haven't had a trade today, that's good. But if you sat down your charts and you saw this right now, would you feel inspired to trade it? Don't look at it like this. Like if you saw it naked, no lines on the chart, would you feel like, oh yeah, I definitely want to trade that? Why? What are you trying to do? You have to know where these problem areas are, where price will be absolutely manipulated. And I've never seen a book, I've never heard a teacher or author or educator or whatnot clearly articulate the conditions that would present these very things here. It's not the same as saying, okay, ahead of FOMC, the market can consolidate before. Everybody knows that. Like everybody knows that, but it doesn't always do that. It doesn't always do that. But whenever there's two market drivers in the same session, I anticipate this type of whipsawing, fickle price action where it can trap you. And many times what you think is there in the chart, the opposite's coming. The opposite's going to just spring out there, and you're like, man. And at 4 o'clock, it's going to all look obvious to you. The people that got short below here, on a break below that, selling weakness. What do you think they're feeling right now on the confidence scale? Do they feel like they're ready to conquer in everything, or are they sweating right now? Remember, the run above here, the buy stops were used for what? The bull flag traders. Their stop loss is going to be placed where? If they get filled on a break above here, their stop loss is going to be what? Below here. They got tagged. So far, nobody's profitable today. They keep banging both sides, both sides, both sides. This is seek and destroy. For a profile sense, this is seek and destroy. And what's going to happen at 10 o'clock? The real run, the purges everybody where the majority of the liquidity is. That's what's going to materialize. Everyone wants to come out here and trade bone thugs and harmony patterns, and they get caught up in this. You find out it's trading Weird Al Yankovic. I don't know where to get this shit from. This comes off the cuff. Watching paint dry. We're talking about narrative today. We're talking about avoiding problematic trading conditions. We're talking about days that have two economic drivers in the same session. How about them shorts? I can't tell you how many times as a 20-year-old I was trading bonds, I was trading currency futures, uh, Deutschmarks, Swiss francs, like all that stuff. And when the market would do this, man, I would buy, then sell, then buy, then sell, then buy, then sell, and then boom, the account's gone. And then later on, when the move comes, I would swear up and down that if they never would have just stopped me out on that last one, I would have been in that move and got it all back. And that's never true. You're lying to yourself. I was lying to myself then, and you're lying to yourself when you do that too. Sometimes there are days and sessions that are presented as an opportunity, but they're cleverly disguised impossibilities. Teaching when not to trade. That's a novel idea, isn't it? But that's the lesson you need to learn. All right, so just a little bit less than 12 minutes to go before we have that 10 o'clock news event. I'm going to break here because, as I said, I want to see it with my own observations. I believe we're going to go above the blue line, and then once we do that, I would like to see it take out the low of, what will this say here? Well, there you go. Thank you for giving it to me beforehand. Thank you. Thank you there, buddy. I almost said your name. The The shorts have been murdered. The longs on the breakout were not allowed to be profitable, and we're trading up into that shaded area I talked about this morning. Not quite yet. It'll be there. So thank you. I appreciate you guys at the exchanges working with me in my schedule today. I was getting ready to leave them, and you helped me out. So thank you very much. And hopefully you found something in all this insightful. Hopefully it allowed you to understand more about what you should be avoiding, even behind all the mess and the chop. If you understand what price is likely to do, how it books, how the algorithm actually delivers price, how it engages and uses sentiment and entices traders to do things from a sentiment basis. All those things are narrative, and it's not something in books. It's not something in other people's courses. You have to sit in front of the chart for a long time, months, years, and then you'll develop the skill set. Do you need to have this much detail in understanding price to be profitable? No, you can have a very simple model like I've already taught. But if you really want to be an ace and you want to know what you're doing and how to avoid the pitfalls of everybody else out there, and you want to find something that has absolutely unrivaled precision and sound logic, you found home. Okay? Everything that I'm putting up on the YouTube channel, when I go away in November, none of that's going down. It's for your learning. It's for your edification. I'm encouraging you to use it, study it, share it with your family members, have them study. If you have a child that you're homeschooling, try to find a way to incorporate some of it, okay, and start them young, and it'll give them a great deal of head start, and not just limit them to just whatever the curriculum that you have or what would have been subscribed to you as the curriculum, to help build them as a good employee. Teach them a skill set to help them become an independent thinker, where they can go out there and act as an entrepreneur. And even without a brick and mortar type business, they can still find a way to carve out their own existence and not limit it to whatever someone else would prostitute their time for. So enjoy your weekend. Have a very safe weekend. And I'll be with you all on Twitter in the morning tomorrow for a Shotgun Saturday Twitter space. Until next time, be safe.